In the continuation of the above video, today we are going to see the functions of business finance. Business finance has different types of functions. Mainly, business finance plays a crucial role in supporting the operations and growth of a company. Its key functions include planning, directing, and controlling financial resources. First, we will talk about financial planning. Setting financial goals and strategies to achieve these goals, financial planning plays a vital role. Secondly, financial forecasting. Predicting future financial performance based on historical data and market trends. In financial control, the function of business finance means the monitoring and evaluating the financial performance to ensure that goals are met. Financial reporting. Preparing financial statements to provide information to stakeholders about the company's financial position. In that, the trade financial functions plays a vital role. The finance function of past decades centered around paper-based manual transactions and processing. It arranged the procurement of new financing, accounted for various forms of operating capital, and contributed to handling the legal matters. Broadly speaking, finance, tax, and treasury were the three core functions. Depending upon the size of the firm, the operating model in place, the finance function may held additionally responsibilities including insurance, investments, and risk management. Its purpose in the organization was to accurately record and report on key financial data such as operating cash flow ratio, gross profit margin, burn rate, cycle time, sales growth, debt to equity ratio, return on assets, inventory turnover, payroll hand count ratio, and many more. The data often lacked dimensionality and wasn't scalable, accessible, or in some cases meaningful enough to make substantive decisions about the future. Finance was successful at back office accounting, but its ability to innovate on behalf of the business as a whole was constrained. These are the some important things in the traditional things. Traditional finance gives the profit maximization, short-term focus, and limited stakeholder consideration, and also involves a static environment. But in modern finance, value maximization, long-term perspective, multiple stakeholder engagement, dynamic and uncertain environment takes place a vital. The content in the modern finance has the evidence of a productive electronic foundation and framework for financial planning and analysis, saving labor, time, and decision making. With the greater speed, visualization and formula based rules built into the back office data could be viewed with a new lens and by more stakeholders outside the finance functions. In that, corporate governance plays an ensuring transparency, accountability, and ethical behavior in corporate decision making. ESG investing is also done in contents of modern finance as it considering the environmental, social, and governance factor in investment decisions. Behavioral finance also have examining the impact of psychology and emotions on financial decision making. Financial technology, in short, we used to call it as fintech, leveraging technology to improve financial processes and its services. The sustainable growth in modern finance has a prompting long-term value creation while considering environmental and social impacts. Stakeholder engagement, involving all stakeholders in decision-making process to ensure shared value creations. Ethical practices, adhering to the ethical principles and responsible business practices in all financial activities. Technological invention, embarrassing technology to enhance financial process and provide innovative solutions. While the internet drove the proliferation of business application in 90s and early 2000s, the way finance was conducted remained largely the same even though technology reshaped